Well, hi, everyone. Maybe you have a small business in the state of Idaho, or a large business, could be any type of business. But if you just want to figure out how to withhold the correct amount from your employee's wages, and your employee lives in Idaho, well, Idaho has updated their tax rates slightly, just fairly recently, that being in May of 2023. They made an update and they did make things a little bit better for the employer, for the taxpayer. They did slightly lower the amount you'd be taxed. They didn't really lower their rate. The rate is still 5.8%, but they did up the threshold slightly, related to the amount of money that gets taxed. So this video is going to show you how you would write a formula to figure out exactly what your employee's withholding would be. And it's an example of the payroll SPRAP, or the payroll application in Excel, that can do payroll for any of the 50 states and the Virgin Islands and the District of Columbia. And in this example, we'll show how the Idaho version works. So what do you need? Well, if you're in Idaho, you need your employee first to fill out a ID W-4 form, which is this. It's pretty easy. You're going to choose a filing status: single, married, married at single rate, which is just like filing single, basically. You get to choose the status here, and then the number of allowances you have. And that's generally going to be children under the age of 16. That's basically what your allowance number is going to be. Put that there. So once you have your employee fill out this form, you put that information, you log that information. Is your employee, you have an employee name here? Is your employee married? Yes or no? How many allowances do they have? We're putting 1 for them. And then we fill out their status about whether it was A, B, or C. Were they single? Were they married? Or if they were married at single rate, you can just put single. That's fine. You don't have to do anything else, just really single or married. Because as you'll see, there are really only 2 different tables of tax formulas as shown right here, which we'll get to in a second. So you grab that information from your employee, their marital status for here, and the number of allowances for children age 16 and under. Then you get to, as you log their payroll information, their hours or their wage, you have to figure out, well, all right, then how do we apply the tax rate to this employee status that we've just identified? And we're going to do it with a formula like this, and I'll explain what's going on in this formula. Just making it a little bigger so you can see it, hopefully on a big screen. So what are we doing? Well, we're going to tax some of the wages of the employee. We're going to tax a certain amount over a certain amount. It depends on the person's status. So if the person is a single or married filing, married but wants to be taxed at the single rate, or the head of household, all those 3 statuses, everything except the married who wants to be taxed at the married rate, they're all going to have this formula applied, which is 5.8% of the amount, the annualized amount. I mean, you got to expand out the person's wages for their pay period to the entire year and say how much would they be making the entire year, which is going to be the amount they're making during the pay period times the number of pay periods in the year. So if it's a weekly payer, you're going to multiply it by 52 because there are 52 weeks in the year. How much are their wages for the period? Multiply it by 52. Then you're going to subtract out this 13,850 from that total wage amount. But you've got to do something even before that, which is you have to reduce out however many allowances they put on that form on the ID4. Each annual allowance is $3,534. And, if they put 1 allowance, 2 allowance on there, you'd have to multiply this number by 2 to get the total amount of annual allowance that gets pulled off of the wages before you start taxing them. So that's basically what we have to build into one formula. And this is how we did it, is I separated one formula for all the rates that are not married and one formula for the rates that are married. And this is what it looks like as we go through it real fast. We're going to be rounding this whole number to a whole number. So there's a round and a 0 at the end of this formula because we're rounding it to the dollar. So you put round 0. Now what it wants to do is it wants to take CP4. CP4 is the annualized taxable wages for the employee, which is already figured out in this file. That's going to be the taxable wages times the number of pay periods in the year. You're going to take that annualized amount. You're going to subtract out IDEX. IDEX is what I've named one annual allowance amount, or the 3,534, times the number of allowances that the person has claimed. That's what my cell K4 is. It's the number of allowances. So you're taking that allowance amount, times it by the number of allowances. And you're also subtracting out what this buffer amount is that is non-taxable after your preliminary taxable wages are calculated, right? So annualize your wages, subtract out the allowances times the allowance amount, then subtract out 13,850. That's going to get your taxable wages if you annualize them for the year. And then you're going to multiply that by 0.58, 0.058, which is 5.8%, 0.058. Then that amount is going to get divided by the number of pay periods in the year to get what the tax is for the pay period. And if that amount is greater than 0, then that's the correct tax. If the amount is less than 0, then you don't want to withhold any tax. That amount could be less than 0 that gets subcalculated there, because you could have somebody making less than the amounts of their allowances and their standard deduction amount. It could be less than that. It could be less than $17,000, $18,000 potentially if somebody had a light pay period or whatever they're making. There might be no tax due and it would be a negative number. So if this number ends up being less than 0 and there are more allowances and deductions than there are actual wages for the period, it will resort to 0. And that's what this formula does. And the same exact thing for the married formula, except the standard deduction amount is 27,700 instead of the 13,000. So that's all that changes in that formula. It can be seen right here. Here's the 13,850. Here's the 27,700. And that's it. Then what you do is you choose which status is the person. This is the Idaho final. Idaho final state tax withholding. It chooses the right one based on which status you chose for the person. And if there's 2 H's in withheld, I think, no, maybe not. Let's go with that. I think if there's 2 H's in withholding, I'm pretty sure. I should know by now, right? So this is the correct amount that's going to be pulled through, and that's how you do it. It did reduce tax liability a little bit. The way they used to have the formula didn't give as much of a standard deduction, I believe. So this is resulting in a reduction. You know, when you end up looking at your pay stub, you see that this amount was about like $101 before they made the adjustment. I was testing the old rates. So it definitely does save a little bit because it's bumping up the standard deduction amount, really. So that is how you do Idaho withholding. It all rolls into the payroll file, where as soon as you enter in employees' information, you get pay stubs that you can just toggle each week's pay stubs. The first one will be a little bit different here. Nope. Everything changes. You can choose different employee names. You have your quarterly reports all showing up here that you can just simply choose whichever quarter or month or pay period you want to see, and all the reports fill out automatically. State reports over here. W-2s, same thing. It's going to subtotal everything up for the W-2s. And we also have pivot reports where you can do dynamic reports to look at anything you want for your employee. So that is basically how you do Idaho. It's not that bad. You did get a slight tax reduction if you're in Idaho for 2023, as they updated it in May. So payroll should be easy, everyone. We're making it so, and you can go to kimbraverman.com, pick up copies of this file, and run one for your small business in any state, Idaho obviously included, but all the other states I have formulas in here as well to do them. All right, so good luck. Payroll should be easy. We are making it so in Idaho.